Welcome to KBRA Podcasts, where we cover topical research discussions, industry commentary, and more. Stay tuned for insight from our knowledgeable team members.
Hello, welcome European listeners and market participants, and welcome to KBRA's latest European Credit Podcast, Conversations in European Credit. I am Gordon Kerr, Head of European Research at KBRA, and today I'm joined by my colleague, Kali Sirigudi from the RMBS team. Today we will be covering the UK consumer. They are currently facing a difficult period, facing the challenges of higher inflation, rising rates, and in particular, increased energy prices. We will start by taking a look at the UK consumers' confidence. They have reached their lowest level in over a decade in terms of a survey, the GfK survey on consumer confidence. The outlook for them in their minds is not particularly positive. In particular, the focus is on around their future unemployment prospect. So the potential for them to become unemployed was noted as a particular concern. They're also facing challenges in terms of their ability to pay for rising energy prices, as well as rising rates impacting their ability to maintain low payments on their borrowing. Inflation is a big part of the impact upon consumers. Inflation levels have been rising at around CPIs reached around over 10% in July 2022. And the expectation is that this can increase to levels as high as 18 or 20%. Recently, the new government put in place a cap on prices. However, prior to this, the expectation was that inflation and in particular energy prices were going to escalate to a point that they would put considerable pressure on consumers going forward. Energy prices has been the biggest part of that inflationary picture, following through into the transport sector. And then as we have migrated through this period of high inflation, it's now starting to feed into other areas such as food and non-alcoholic beverages, the restaurants and hotels as well. As this energy challenge continues through, the ability for these businesses to pass on prices puts pressure on the general UK consumer. If we take a look at how the UK consumer has performed in terms of their overall pay, they are benefiting from a tailwind in that respect. So nominal pay increases over the past year have been quite high on a historical basis. However, once inflation gets incorporated in the more recent periods, that has turned negative. So total real pay recently has turned negative, considerably negative, and is a concern as we move through the winter. As I highlighted earlier, the energy crunch is the area of particular concern, with the overall expectation that an average consumer is going to see their energy bill rise from around $1,971 in the period up to the 1st of October. It was expected to increase to $3,549. However, the government has recently put in place measures that will be implemented to bring that back down to around $2,400. So now that is a considerable pullback from the 3,500 number, but it still is much higher than consumers have experienced over prior years, where the actual average was around in the neighborhood of 1,000, moving up to 1,900 most recently, and the plans to step up even further. This is going to put a considerable crunch on the consumer's ability to have money in their pockets at the end of the day. As I highlighted, nominal pay has increased, which is a positive. But as inflation ticks up and squeezes individuals, they are also getting squeezed by the increase in rates. So as the Bank of England targets to fight inflation, they have begun to put up rates, and those Bank of England base rate is now up to 1.75% from a level which was as low as a record low of 0.10%. So this is increasing the cost of borrowing at the Bank of England base rate, so on an overnight basis. But this is also feeding through into longer dated borrowing, such as mortgages. Mortgage rates have increased considerably. They have gone from a low of roughly around 1% for a 2-year, 75% LTV fixed rate deal. And these have now gone up in terms of the offering to around 3.5% for a 75% LTV 2-year mortgage. That is going to considerably impact upon borrowers and homeowners as we move through the coming year. And what I'd like to do now is to bring in my colleague, Kali Sirigudi from the RMBS team to take you through the expected impact that this could have on residential mortgage borrowers. Kali?
Thank you, Gordon, for setting that background to the current unexpected financial stress for consumers in the UK, and particularly when you refer to how the Bank of England is trying to tame the observed inflation and the expected inflation by increasing interest rates. Now, as regards to mortgage market, that increase in interest rates is directly affecting swap rates. Now, the fixed swap rates in the UK are important from a mortgage lender's point of view, because in general, the cost of funding for a bank or a lender is floating, while the product offered to UK mortgage borrowers is usually a 2 or a 3-year or a 5-year fixed rate mortgage product. In order to be able to offer a fixed rate mortgage product, the fixed swap rates are, and where they are, is a very important factor driving the mortgage interest rates on offer. And each time the Bank of England has revised the base rate upwards, the swap rates and the expectation of swap rates has gone up, which has increased the mortgage interest rates for the fixed rate products in general. Now, that surely meant that for first-time buyers in the UK looking to purchase a house, the eligible loan amount, given those higher interest rates, straight away was lower as compared to 6 months ago or 9 months ago when the interest rates on offer were relatively lower. So that's number one. It certainly is going to affect the demand for house purchase, given that the first-time buyers will not be eligible for bigger loan amounts. So that's the first effect we are already seeing. The second is, of course, in terms of the outstanding mortgages in UK. Majority of the outstanding mortgages are on fixed rate interest. So while they will not be affected, the monthly installment will not be affected by the increase in the base rate. But for those borrowers who are coming off their fixed rate mortgages this year and the next, will surely be facing the prospect of higher interest rates. So borrowers with lower loan to values, as far as their current outstanding is concerned, will find it relatively easier to remortgage at the higher interest rates, whereas for the outstanding mortgages at the higher LTVs will mean that it will be tight as far as affordability is concerned. So remortgaging could be a challenge for borrowers this year and the next, given the high interest rates for mortgages on offer. Second, as I said, first-time buyers will be affected in terms of their loan eligible amounts. And thirdly, those planning for a larger home with increased borrowing will also face the prospect of lower eligibility as far as affordability is concerned. So how does this affect the UK mortgage market or the house prices? It will mean a lower demand for house purchase in the UK, which means the growth we have seen in house prices in the UK should taper off. And maybe there are some declines observed for some of the regions in UK. So we expect that there will be some cooling off as far as house prices are concerned. As regards RMBS performance in general, I've already referred to the fact that since majority of the outstanding mortgages are fixed rate, so you will not see potential rise in delinquencies for loans which are currently on those fixed rates. But then for borrowers who are currently paying a floating rate of interest, particularly those which are paying a floating rate of interest linked to Bank of England base rate. For a decade or so, these borrowers have paid the lowest interest rates observed in the UK, but that is changing each time the Bank of England revises the interest rate. So we expect to see an increase in delinquencies. Yes, it's not just the interest rate, it's also the pinch on the household disposable income as regards inflation and cost of living, which may mean that what is available to service the monthly installment is a smaller amount now. So increase in delinquencies seem inevitable. Banks and servicers are expected to be able to offer temporary forbearance measures. And there is a recent success story where banks and servicers were able to offer payment holidays to borrowers affected during the COVID period. And at the end of that payment holiday period, we saw that majority of the UK mortgage borrowers were able to come back to normal payments almost straight away. So that positive story should mean that banks have learned from that, and then temporary forbearance measures will help some of these financially stressed borrowers to deal with a difficult period going forward. As regards foreclosures, that's the last option by any bank or servicer with regard to mortgage defaults. But any increase in defaults is usually with a lag. KBRA expects that defaults would be 12 to 18 months from now. But the supporting factor for only a small rise in defaults will be the low unemployment number currently. So that's on performance. And there is a particular situation which RMBS transactions find themselves in right now. For example, with each rate rise by the Bank of England, loans paying a floating rate of interest may have the reset on their loans with a certain lag, whereas the rate reset increase the SONIA, which needs to be paid on the notes as regards the interest to be payable on a quarterly basis. So there's a timing mismatch between when that interest on the mortgage is reset versus the reset of the interest rate on the notes. And that timing mismatch is leading to deferral of interest on some of the junior notes in outstanding RMBS. So that's expected for every such instance where Bank of England in the future revises interest rates upwards. But then is that a concern for RMBS in general? Not really, only because the basis mismatch is a timing mismatch as regards the reset of the interest rates on the mortgages versus the notes. So we do not expect that this is concerning for UK RMBS outstandings. And the last point to be made, unique to the current scenario of increasing interest rates, is the timing mismatch of reset of floating interest rates on legacy portfolios versus the reset of SONIA on the notes interest rates. Now, such mismatch is potentially to cause deferral of interest in some of the UK RMBS transactions, particularly for interest payable on the junior notes. While this is not a concern only in terms of the terms and conditions of the notes, where junior notes under certain circumstances allow for deferral of interest to be paid ultimately before the final maturity of the notes, KBRA in its analysis tests for such potential deferral by stressing not just delinquencies based on the stresses which are applied as per stress scenario, but it also tests the basis mismatch between a difference in the interest rate index between the assets and the liabilities, and or a timing mismatch between the reset of the interest rate indices between those on the assets and that on the interest on the notes payable. With that, Gordon, I hand it back to you. Thank you.
Thank you very much, Kali. One of the elements of the UK consumer that is a positive coming into this environment comes from the pandemic period. During that period, UK consumers managed to increase their savings. The overall level of cash within UK household bank accounts increased both in 2020 and in 2021 as the UK consumer was in a relatively positive position from a cash flow perspective. They were consuming, still being paid either through furlough schemes or directly by working from home. And as a result, were still receiving income, but their outgoings were considerably decreased. As a result, UK consumer bank balances increased. And as of recently, those increased levels have started to decline. So while they start from a positive position, that positive position is beginning to be eroded as we currently migrate into the winter period. And the inflation is starting to bite in terms of individuals, as well as the return to work, broadly speaking, and the overall consumption of more cash. Now, savings have not necessarily turned negative, but they have considerably decreased from their high levels of savings in the pandemic period. Further to this, as we look at the forward-looking towards the impact on consumers, we've seen that their expectations are very low in terms of their confidence. And what we're starting to see in terms of the actual consumption side of things, UK consumers are starting to increase their levels of borrowing, in particular unsecured credit. So UK consumer lending has started to increase from the use of credit cards. Credit card balance growth is now in the double-digit percentage year over year. It was negative during that pandemic period, considerably negative. In the beginning of 2021, UK consumer credit card lending growth was minus 20% at the beginning of 2021. And it is, as of the end June 2022, is at a high level of 12.5% year over year growth. So consumers are starting to spend on their credit cards, and that is a concern and a worry. However, when we actually dig a little bit deeper and we go into the next stage of actually looking at delinquencies on UK consumer credit cards from the information we have out of these securitization markets, we can see that delinquencies, both 30 days, 60 days, 90 days, has been pretty stable for the past nearly 10 years at a very low level. And there is concern that that will start to increase. And if anything, we feel that that is likely to be the first point of stress. So where we will start to see consumer stress will come through in those credit card delinquencies. And we haven't started to see that yet, which is a positive in terms of the overall performance of the UK borrower, going back to the point that they are coming from a position of strength, high levels of savings, low unemployment, low interest rates in terms of as Kali pointed out, a large portion of mortgage borrowers in particular taking out fixed rates at those low levels. So it's going to take time before they start to feel any sort of a pinch from the higher interest rate level. And so what we will be looking for over the course of this winter will be that two things, really, the unemployment rate and whether or not that starts to increase, and UK credit card delinquencies as a sort of early warning sign for the relative stress of the UK consumer and the UK borrower. So in terms of the unemployment picture, that has actually been quite positive. UK unemployment has been maintained a very low level. That has part been, as has occurred not just in the UK, but around the world, a degree of increased inactivity, so individuals exiting the workforce. But the overall unemployment level still continues to remain quite low, with large numbers of job vacancies at the moment. Whether or not the energy crisis will start to impact businesses and have them start to tip over or decrease their headcount is yet to be seen. There is some concern that will happen over the course of the winter and into next year. And overall, I think the question is how long this energy crisis will last. If it is a period of several months, then there's a large number of both borrowers and businesses that can potentially weather the storm. But if it continues on an ongoing, longer-term basis, then there are concerns that that could start to feed through into increased levels of concern around the individual borrowers and businesses. So, as you can see, the overall picture that we present with regards to the consumer in the UK is that they are in a concerning period and a challenging period over the coming 6 to 12 months. However, they come from a point of strength with low levels of unemployment, high levels of savings, and low levels of interest rate borrowing as consumers were borrowed and locked in at fixed rates at low levels. As we look forward, we will continue to monitor the picture and, of course, present you when we see any sort of increased levels of delinquencies or concern. Make sure you are registered on our website, kbra.com, to be sure to capture our latest publications as we monitor the situation with regards to UK consumers and other elements in the markets. Be sure to subscribe to our podcast in order to catch future episodes covering content from corporates to securitization. Thank you very much for listening. We look forward to bringing you more conversations in European credit, and we'll speak to you again soon. Thank you.
This concludes our episode. Please continue the conversation on LinkedIn and Twitter at Kroll Bond Rating. We'd also like to remind you that all of our ratings and research reports are available at kbra.com. Lastly, please share any feedback or ideas for future podcast episodes by emailing us at media@kbra.com. We hope to see you next time.